Hey everybody, welcome to this free edition of our Trading Group Weekly Roundup for the trading week ending July 5th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme for this holiday shortened week is what can go wrong. And I'm not talking about this week, but I'm talking about this summer. So let's take a look at where we've been this holiday shortened week here in the U.S. markets, and then we'll kind of take a step back and go out a little bit further in time. You can see for the week, every index in the U.S. was up, with exception of the small cap. That'd be the Russell. It was down 1.14% for the week, which dragged it under year to date. We've had the widest divergence between the Russell, the small cap, and the tech-heavy NASDAQ in decades. You can see NASDAQ's up 22.25% for the year. Small cap is down 0.13% for the year. That's over 22% dispersion. Folks, that's not going to last. I'm expecting a little bit of a pullback here. But the markets basically are showing a lot of strength. We had record highs in not only the NASDAQ, but the S&P this week. NASDAQ's up almost 73, a little almost 74% from the lows where it began its rebound in late 2022. All right. Meanwhile, the Dow, which has got a lot more value-oriented companies in there, since that late 2022 move higher. They're up about half of NASDAQ, about 32.79, 32.8%. So the Dow is clearly trailing the way. And we had markets here in the U.S. close half day Wednesday, all day on Thursday. We had our Independence Day holidays. Trading volume was relatively light, all right? And what we did see this week, on Monday, ISM, we're seeing some slowing down in economic data. ISM actually moved below 50 to 48.5. That's the lowest it's been since February. And then we did get a surprise contraction in construction activity as well. Got a sharp downturn in all of the data. ISM, both manufacturing and non-manufacturing. On Tuesday, we got the JOLTS data. That showed job openings rose slightly less than expected, 8.14 million, down slightly from what they were expecting. And it's the lowest level it's been at in 3 years. And then this Friday, today, we saw job numbers come in early this morning, 206,000. So it's kind of confirming a slowdown in the job market, right? We did see the unemployment rate ticking higher just a little bit, 4.1%. Wage growth came in at 3.9%. And then, of course, we had Boom Powell's comments over in Portugal at that conference over there. That kind of also helped drive a decline in longer-term treasury yields as the markets moved up on the idea that Boom's going to do at least one rate cut, possibly even two. All right, so these are really keys that I'm seeing in the markets. You can see the PE ratio still elevated at 24.05. The forward PE ratio 22, a little over 22, so it's a lot higher than it should be. Okay. You can see the best and the worst performers weekly and annually for the U.S. sector performance. And shouldn't be a surprise with real estate bringing up the rear, communication services leading the way, and sector performance. Okay. Then, of course, if we go over to Europe, take a look over there. You can see Christine Queen Bee Lagarde, she's the ECB president. She kind of, after they cut their rates once, she looked like she was striking a slightly more hawkish tone now. Said Europe's still facing uncertainties, so they're going to be data dependent like our Feds here. So they just want to gather more data to make sure. We also saw Euro inflation coming in June at 2.5%, yet services data is showing that it's still stubbornly high, much like it is here in the U.S. regarding inflation. And then we did see Germany's manufacturing base, which, they're the big economy all over Europe. They weakened even further in May. Seasonally adjusted orders fell 1.6%, while industrial production contracted 2.5%. So all the markets were in the green this week. When the U.S. is closed for a couple of days or 1.5 days, it does tend to create less volume globally. But the markets just slid higher. Year to date, everybody's back in the green across Europe, even the CAC 40, the French market. once they realize that Marine Le Pen's not going to be totally in charge, she'll be weakened just a little bit. But the progressive gained a lot in France. So that moved France back up just a little bit. They're 1.76% year to date. You can see if we go over to the Asian markets, you can see the Nikkei had a really strong week. Year to date, they're up almost neck and neck with the NASDAQ here in the US. They're up 22.20%. They're still pumping money into that economy, and they're just going to keep pumping it in. The average wage increase in Japan came in at 5.1%. Excuse me. Excuse me. Wow, I don't know where that came from. But the wage increase in Japan, that was the biggest uptick in like almost 33 years. So we're going to see that's going to add to the inflation. Remember, in Japan, they want inflation. They want it to go up. Although we did see Japan's economy shrinking 2.9% year over year in Q1, as I said. So they're close to going back into a recession again. Really amazing. But the Bank of Japan just keeps buying government notes over there and bonds, and they keep pumping money into the economy. So, and that's what they've been doing for several decades now. The yen is at 38-year lows. We'll see how that all shakes out. And then, of course, if we go over to the Chinese markets, you could see China was up barely for the week. Year to date, it is in the red. Hang Seng was up barely, and just barely up year to date, 4.47%. The manufacturing sector in China, 2 months in a row, it fell to 49.5. That's in contraction territory. All right. New orders, exports also declined. Value new homes and real estate there dropped 17% year over year. All right. Now it declined 34% year over year last month in May. So they could be finding a bottom, but it's been 4 years since they had that real estate blow up, and it took the US 4 to 6 years to get out of ours in 08 and 09. So they're pretty much on track to finding a bottom there. We'll see how that plays itself out. And then finally, one other chart I want to show you here, just to kind of remind you guys, this tracks the SPX since 1920. And you can see the returns for each decade, the 20s, 30s, 40s, and so forth, up to the 20s here until we get to 2030. You can see the average performance for the decade. And there's only been 2 decades where we've actually finished the decade lower. That was the 30s, which incorporated 1929 here in the US. And then in the 2000s, it had not only the dot-com bubble, but it had the 08, 09 crash as well. All right, remember the dot-com bubble, everything crashed pretty hard. And then 08, 09, believe it or not, the S&P crashed even harder. But you could see the decade average of returns, 106% for a 10-year average of roughly about 9.67% each year. And then you could count the number of bear markets in each decade. And then you could see the average length of the bear market, roughly about 289 days on the far right, 9.5 months average bear market. And you could see the decade average performance down at the very bottom. So we've had 27 official bear markets starting in the 20s. Each bear market averages about 35.62% to the downside. Okay. So if you look at the bear markets on average, we average 0.21 bear markets per year, right? Which means you got about a 20% chance of a bear market in any given year. But generally, for a 10% pullback, and I don't have that data, you average 10% pullback every year, right? And 5% several times during the year. We haven't had that. We've been over 400 days since we've had more than a 2% pullback on any given day. So we're starting to stretch the movement to the upside, right? So I do believe this summer months we're going to have a reason. The markets will find a reason to pull back. I told our members, 4 to 8%. Now I was pretty much right in the middle of that for the April pullback, and we got it correct. So for the summer, I'm seeing the same thing. I don't see much more than tops 8 to 10%. The skews in the volatility futures are normalized right now. So I don't see a lot of issues with any of that. So now I'm going to switch the screen over. Let's go take a look at the E-mini S&P 500 futures and just kind of where we are, where we finished out the first week in July, right? So we'll see how that shapes itself up. It'll take a couple of seconds to come up on your screen there. All right, so now you can see here, I've got two potential pullback points. We're on an Elliott wave 5 right here, so on a daily chart. So that would suggest that little gap right there, 54.54. So let's call it 54.50, right? So that's roughly, 150 points or so south of where we are now. And then a little bit further out in time, in the August time frame, we could pull back to about 5,300. So I'm still looking at that. You can see the upward vector of both the 50 and the 200, but clearly a test of the 50 to me seems more than 50% probable over the summer months. In the MACD, there is no divergence, so that does suggest that any pullback, it will be bought. Dips are going to be bought, right? So I'm kind of seeing that. NASDAQ is on fire. Now, this is the NASDAQ 100. You can see here all-time highs for today, up 21.38% intraday. So still very high, right? And you can see there is no divergence here. So we're going to get a pullback here. You can see the 50 EMA pretty much following the trend line. So I think a pullback to the trend line. The nearest term pullback is probably going to be right at that gap right there where we gapped up, right around 19,691, right? So that's about 1,000 points south over the next month and a half or so. I could see that very, very easily in NASDAQ. All right. And then, of course, the Dow is, not really going anywhere. The value oriented, the larger companies you can see here is pretty much running steady. And then, of course, if we look at the Russell, it's back in the red again. Okay. We closed down today. You can see the dividing line between being in the red and being in the green for the year was the closing price here. And you could see we've just chopped up and down, up and down, up and down. We have gone nowhere. Like I said, it's the biggest divergence between NASDAQ and the small cap Russell in quite some time, a decade or so. That will close. And I suspect what will happen is we may have NASDAQ move down while the Russell moves up a little bit. Now, remember, the Russell small cap loves interest rates going down. So the minute the Feds commit to a lower interest rate and actually execute on that, you'll probably see a sell the news with the tech, and you'll see NASDAQ or the Russell move up a little bit. So I'm expecting something like that as we move forward. And then, of course, if we come down here and we look at the bond market, you can see here the bonds are pretty much not going anywhere. We've seen interest rates move up and down. Now, gradually, the rates have been moving down a little bit. But I think we're going to get a lot more information as we get earnings coming out in the next couple of weeks, and then the Feds the end of this month. We'll get a good idea where the interest rates and where the bond market wants to go this summer. Euro, all right, you can see the euro here is moving back up over this. I like euro dollar, long euro dollar, or short the dollar, but I do like the euro to the upside. Same thing with the British pound. The British pound is moving up a little bit because their election there, the Conservatives got crushed. And generally, when you put the Liberal Labour Party in, they're going to spend a lot of money. So the economy generally likes that near term. So I could see that going up as well. But the one I really like is the yen. All right, the yen, I do like that to the upside. You can see here the risk of a bigger move in the yen obviously is more upside risk than downside risk, right? And this is on a daily chart, but you could see downside, I think it move another 6% to the downside, right? But upside, I think it can move a pretty good bit more to the upside, right? So that's kind of what I'm seeing on the yen here. Now, of course, if we come over here and look at gold moved up today a pretty good little bit, right? You can see gold is holding the 50 EMA. What I said about gold is if it breaks the 50 EMA, it's going to come down and test down here this gap that was made back over here in early April. It broke to the upside here, but I think it's going to be very limited in an upside movement. My original target for gold was up here at 24.81. We got up to 24.54, and then it's just been chopping sideways. I think we're going to see that for a little bit. It may make another attempted run. It'll fail. I think eventually over the summer months, it's going to come back down and fill this gap here, right? Same thing with silver, right? Silver was sitting on the 50 EMA. It closed below one day, and then it managed to get back up, and it's taking a run too. It's going to make another attempt here and then roll back over in the summer months. And then, of course, if we look at oil, you're going to see here with oil, it's moving up off these lows. There's a lot of geopolitical risk or a lot of potential risk with Iran, Lebanon, with Hezbollah there, and Israel duking it out, and the Houthi rebels in the Red Sea. So that is keeping a war premium on oil. I don't see oil going too much higher. It's going to stay in one of these ranges. And members, you guys know how we like to trade this. So it's a pretty good trade for us. Nat gas is still coming down, but I don't think it's going to go down too much lower. I think now that it broke the 50 and the 200, it could probably run down to about 2.15, consolidate down here. Our big trade with nat gas was back over here in March, April timeframe. All right, everybody, that's a quick update rundown for this holiday shortened week. Members, I'll see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. We got some good trades that I think they're going to be setting up as we go through the summer months to the end of the year. Have a great evening, great weekend, everybody. Members, I'll see you Sunday evening for our weekly market watch. Ciao, folks.